Hello folks, welcome back. This is our weekend review for the ICT Mentorship for week ending January 31st. This is our economic calendar for the week ahead. On Monday we have German IMO business climate for Euro during London Open. Tuesday we have London Open medium impact Spanish unemployment rate. 8:30 a.m. medium impact for New York session core durable goods orders. 10 a.m. we have high impact consumer confidence for the dollar and Richmond manufacturing index medium impact. And then 7:30 p.m. I have high impact CPI for Australian dollar. 10:30 a.m. New York session medium impact crude oil inventories, watch Canadian dollar. 2 p.m. we have FOMC statement, federal funds rate, and the press conference at 2:30. Thursday, we have German preliminary CPI. 7 a.m. New York session, high impact Bank of England monetary policy report and official bank rate vote and monetary policy summary and official bank rate. So Thursday is going to be the heavy hitter for cable. 8:30 a.m. high impact advanced GDP for dollar. Friday, we have 3 a.m. medium impact Spanish flash GDP and CPI numbers at 5 a.m. for Euro. High impact GDP Canadian dollar New York session 8:30 a.m. And the dollar has a few medium impact drivers for New York session as well. And then 9:45 we have Chicago PMI. Okay, so the price action lesson for this week will be intra-week order flow. Moving on to dollar index, this is our daily chart. As you can see, we had a really handsome run up into our buy-side liquidity pool we were looking for. The next draw on liquidity is the equal highs here. Okay, so what I'm watching is how we're going to trade inside this SIBI. Okay, there's nothing saying that it's going to go up there or up through these highs yet, but I'm watching to see what we get in terms of price action in here. Remember, watch this particular candle right there. Okay, that's the low of the SIBI or fair value gap. We're going to be looking for that level to show a willingness to allow price to trade through it, not see it hit it and then go down a little bit or consolidate around it. We want to see it go right on through it and have really no resistance whatsoever. Usually we would like to see something like this for a institutional order flow entry drill for a short. But with the context that's here, we don't want to see that. That's not what we're expecting. We want to see the opposite. We want to see this level offer very little, if at all, resistance and just allow price to go right back up inside this sell side imbalance, buy side inefficiency to get back to this particular, with a very candles high, or the highest candle rather, the low of that candle. We want to see it trade all the way back up into that, essentially 98.23. So that's the price level I'm looking for, but how we react or trade inside this SIBI, if at all this week, that's what we're monitoring. Any bullishness above that puts us in contention for the buy side liquidity pool being ran out and then the fair value gap that's over here. Okay, so I have the anchor for your focus, okay, in other words, the magnet. Okay, so this is the draw on liquidity. So make sure you pay attention to what I'm about to say here, okay? When we have equal highs or equal lows, they are the draw on liquidity. That means price is going to try to gravitate towards that. Sentiment engineering by the central banks may offer an opportunity for the market to not want to go back up there at some point. And that's what the midweek and weekend reviews are there for, and for Twitter also. Because if I prompt you about something that may be changing gears, or if there's a stance that's been, I guess, recalibrated on directional bias for IPTA, the equal highs or equal lows may be put on a delay. In other words, it won't be traded to. So the easiest way to say this is, right now, this is where the bulk of liquidity rests. Okay, because we've already cleared here. There's really no incentive to go back below here yet, if at all. There is an imbalance in here that I'd like to see it trade up to. So what I'd like to see it do, again, is go right through this high, and then look at this candle right here. Okay, so we have a BISI, then a SIBI. So which frames both of those candles in here, this is a balanced price range. So we may encounter some short-term resistance at this candle's high here, or maybe this one. Maybe this one, because it looks like it's slightly higher. But on your feed, just determine which one of these candles is the highest. Draw that out in time. That's what we're watching to see if there's any willingness to get through that. If you want to just make it real easy for yourself, the 98 big figure, which is basically here, we want to see 98 offer really no resistance whatsoever. We want to see it just trade through it, plow right through it, and then large candles come in, because right now it's obvious. So anyone that has large fund liquidity in the form of shorts being protected by buy stops resting above these equal highs, or relative equal highs as we call it, they are going to be the victim. Okay, or this is where the crosshair should be for central bank runs on liquidity. All right, so that's what we're watching relative to its daily chart. And just go back and listen to the last couple of recordings that I gave you in the mentorship commentaries. Just everything is just so perfectly delivered, and you can't really argue with it because it's all time and date stamped. And this is the reason why I do the PowerPoint slides, because in the past I've had people basically come at me in email and say, hey, look, I joined and I'm looking at these reviews and some of them are just too good to be true. And I'm not patting myself on the back. I'm just saying this is what we do every week. So I elected to use this way of doing it because not only is the videos produced, and you can look at the file names and look at the details on the files, and you can actually see when that file was created. If you go through, like in Windows, right click on it and it'll give you the information and properties about that video. It'll tell you when it was produced. And if you are a member in the mentorship and you're downloading them, you have them in your hard drive. So it's not like I'm going back in and changing. I don't change any video. That's why sometimes in the old 2016, when we first started doing the mentorship and everything was just really unorganized, it was madness. The things that I left there that either I said wrong, or I misspoke, or just made an error of any kind, when you purchased the mentorship, you have access to all of that. I have never, ever went back in and changed or doctored any videos. In fact, there's a video that has an artifact in the timeline that created the video as a longer video that I intended, and I still get emails from people saying, hey, look, this video cuts out at XYZ, but it's semi minutes longer. And I always tell them, yes, because you purchased an unedited, just like you were there at the time. This is what the original group got, and this is what you get. Now, every time I do a video, since I've become more versed with TradingView, I like this because it gives you exactly what my thoughts were exactly at the moment in the minute that I created the chart. So it's undeniable. It's not only is it in the video that you download and watch, but it's also time and date stamped. So there's absolutely zero way for me to go back and doctor any of this stuff. So I'm on the record every single time. I know there's watchdog agencies in here watching me, and believe me, everything is on the up and up. So everything I tell you that I believe is going to happen, I'm on record telling you before it happens. So, I don't get so much of it anymore, but the questions I got from people that joined, the latter portions of last year, it was a large influx of people that came in to the group, and their opinions were obviously very complimentary. That's the way I took it, because if someone says it's too good to be true, that's exactly what I want to hear. I want to hear that as a mentor, because that's pretty much what I promised. I promise you better than anything else out there. And if anyone's doubting that at this point, then I have nothing else that I can do to satisfy that, because you're not paying attention, obviously. All right, so anyway, let's move on into the hourly chart for dollar index. You can see this is our dollar, the fair value gap in here that I outlined on midweek review last Wednesday. I mentioned how we almost came down in here. Just really, if you look at the level here, it's basically the same level here. I'm not sure what's going on, and if you guys are more versed in TradingView than I clearly am, some of these levels they don't always line up, kind of like what we had with, or I had encountered with MT4. Sometimes the levels will move around, and I'm sure there's some kind of setting on the drawings that you can put on your chart, the level of sensitivity. I just don't know how to set it. So if there's something I can set that makes it stay where I want it, and maybe not move as much as it's doing, and it's not moving a lot, I'm just saying that it does move, and it, from my obsessive compulsive disorder that I have, it drives me nuts. So if I could get one or two of you to reach out to me, it doesn't have to be through email. You can just send it through or just say it on Twitter, and I'll catch it that way. I appreciate it. All right, so again, I mentioned in the Wednesday review that we want to see this low be maintained, and we could see it stab down below here, but then reclaim the order block. I actually say that in the video, okay, before this took place. So not only is the fair value gap offering continued support, real institutional support, not retail support where they expect it to bounce down here, okay, that's not what we do. We're looking at the order flow, the imbalance, which it rebalances. Now this becomes what? This fair value gap becomes a balanced price range once price does this. So is it necessary for price to come down to consequent encroachment? No. Is it necessary for it to come all the way down again into the low of the fair value gap? No. Can it? Yes. Is it better if it doesn't? Yes. And that's what I outlined in Wednesday's commentary. And you see it in your charts right now. It happened on Thursday and rolled on into Friday as I outlined. So this is an example of reclaimed order block. I told you as it was happening in price action before it came to fruition. So again, it's not cherry picking. It's very clear visibility. Now, I know some of you are going to say, how did you know that? How did you know that it was going to do this? And how do you trust it? Number one, experience doing it. I'm almost at 30-year mark, okay, doing this. So you can't reasonably expect, just because you're in here, to watch a video, watch a couple commentaries, okay, and then think that you've mastered it or understand how to do it with a great deal of consistency. That's the growth aspect. All of you are going to do that on a different pace. And there's never a clear indication or pathway to judge where you are in the learning curve versus where I was, okay? Because you actually have a greater learning curve in terms of the ability of having a faster learning curve than I did, because I chased a lot of rabbit trails. I'm giving you exactly what I wish I would have had, knowing from my perspective where I'm at right now, looking back, I know where the things were that took me off track of my development in terms of speed. Not that I'm trying to force you to be fast about developing. I'm just saying that my development took 6 years, when if I remove certain obstacles and barriers that I encountered, and I know what they are, and no, I'm not going to spell them out for you, because if you are going through the mentorship, you're going through the process without me having to sit down and explain everything, which is not necessary. But you're getting the fastest route to development than you're going to get anywhere. But you have to submit to the things that I'm teaching you in the order that I'm teaching you. The lessons that I gave in core content while you're still going through them, they are there in a specific order because that is the optimal way of learning it. If you do it any other order, it's going to slow you down. It's going to create barriers, because it's going to create questions that you're not going to remember that you had initially, but then you're going to start focusing on things that are not as important or salient to your immediate need for understanding at the time where you're at in the content. So basically, trust the process, trust me. I know there's a lot of questions you guys have, but it gets answered through the natural progression through the mentorship. Okay, so anyway, the reason why I have the eyeball here is I want to remind myself that while I'm not going to show it in slides here, I'm going to go at the end of the slide portion of the video in the lesson. I'm going to also show you how I got the SMT overlays, because I got a couple people asking how that's happening on MT4, how to do that. Is there an indicator or anything like that? It's really easy, and you'll see it's pretty neat. But nonetheless, everything in here is exactly what I outlined on Wednesday, and Thursday I delivered it. The low on Tuesday for the dollar and then Wednesday's low, and then Thursday's low is created a lower low than Wednesday, but higher than the low on Tuesday. Okay, so in here, there's an SMT divergence that you'll look at with the euro dollar, and I'll show you how to pull that up when we get into the latter portions of the video in the lesson. But the reclaimed order block was outlined. This is the order block itself. It trades back down into it, touches the top of the fair value gap, and it explodes again. There's absolutely no reason why that you could say from a retail standpoint why this low or this old high is the actual level, except for in hindsight. The benefit of understanding how I teach institutional order flow is that once we have a context and a narrative, we know what levels should support. And you can, again, watch the video that I gave you on Wednesday. Listen to the terms, listen to the narrative that I'm outlining, okay? I give you the points at which would negate the idea. If we break this low, it's not any good, and it's probably going to come down here and take out some of this sell side liquidity. But we want to see it stay above that. And if that's the case, the trade idea and how you practice it is you watch it when price comes down, hits the fair value gap, hits the sell stops below this level in here, recapitalizing reclaims orders at the bullish order block, and then you would expect price to rally higher and attack the buy side liquidity pool in here, and then reach for what? That daily equal high. Moving into the 15-minute time frame, there's that buy side liquidity pool I mentioned, and we had sell side liquidity relative equal lows. Price comes down, stabs through the previous low, hits the top of the fair value gap, and it's again SMT divergence in here. Price runs aggressively for the buy side liquidity. Notice doesn't spend a lot of time getting there. It wants to take them out before what? The traders will pull the orders. So while these equal highs are obvious, and the equal highs on the daily chart are obvious, the level of liquidity that is at that price point is going to vary while the market's pricing. So what am I saying? When price is running up to a clear logical level of liquidity, if it's really going to go for that liquidity, is it going to be slow, lethargic runs for it? No. It's going to be very quick, because they have to run aggressively for it, because this is where the liquidity is for it to be offered as a counterparty. It is not buying pressure that leads it up here, okay? It's repricing. The central banks, they have price engines that build in levels of expansion that protects them from the risks involved by offering sell side liquidity, because they are the provider or the commodity provider of price for these currencies. So it's built in mechanisms that allows price to spool and spread away aggressively, and then allow the liquidity to be absorbed. So it's not going to be a long drawn out process, because number one, we're on a 15-minute time frame. Two, the algorithm has been written in such a way where it has to reprice to allow that liquidity, that allows that liquidity to be absorbed and act as counterparty quickly. So once that occurs, then we can go back to a point of rebalancing in here. Optimal trade entry at the 2018 high, and then expansion again, come back, institutional order flow entry drill along here, which is another sell-off for foreign currency. All right, here's the euro dollar daily chart. Oh man, this is so beautiful. Beautiful delivery of price. All right, so I know you're looking at the old fair value gap and you're thinking, you just can't let it go. Well, the reason why it's on here is, and I promise you we're done with it now. I swear to the Lord Almighty, I'm done with these levels in here. Okay, but I did tell you to keep them on for study, because if it did offer me what I'm going to talk about here, that way we can go back and you could have it on your own chart and say, okay, here's what it did, and you can see the reference points. But now I want you to think about what you understand, or what you thought you understood about support and resistance, because of all the textbooks, all the YouTube video mentor gurus, all the talking heads about support and resistance, support and resistance, support and resistance. That goes completely out the window when you understand you have to look at context, because we can all draw lines on old highs and old lows, and yes, there's going to be lots of times where they work, but how many are there in terms of old highs and old lows to choose from? It's nuts. It drove me crazy too. So when I understood and began to understand how price is rebalanced and creates and seeks imbalances to be refilled or rebalanced. Once that's understood, and once that was a very clear process for me to see in price action, then it was very easy for me to go back and look at how the support and resistance theory is just nonsense. So we had this fair value gap here, okay? And I told you, hold on to that level, hold on to these levels, okay, and watch how price reacts to it. We had an imbalance, it trades completely through it again, and then we came back, almost back to the top of it. But look what we get here on Thursday. Consequent encroachment again, but now look real close. Look at the bodies in here. You think that's just a coincidence how all the bodies of the candles had difficulty getting back up inside of the fair value gap? Yes, we wicked into it. Yes, we had opportunities where we were reaching for liquidity inside that fair value gap. The idea that price will reach for these levels inside of a previous imbalance is alien to retail. They don't understand it. Supply and demand, which everybody thinks that is what my order blocks are, they're not, okay? We go through candles. Look at all the candles we went through here just to keep this narrative in mind. And look at the bodies of the candle, how all of the volume, okay, the bulk of the trading was kept below that specific price level. Now, again, yes, we had some wicks, okay? But those wicks didn't go to just, random levels. They went to a level where we've been outlining things in the past. Consequent encroachment, that's the middle of a gap. Just like the mean threshold is the middle of an order block. Well, price is being allowed to go, consequent encroachment here, and then price sends it lower. If you take this information and apply it to our directional bias, which is what we had down here, the little magnet was right up in here, pointing your attention to the BISI in here, buy side imbalance, sell side inefficiency, and sell side liquidity. That's where I outlined and said that that's where price is going to go next. And it did that. It expanded through, didn't offer a whole lot of support here. Why didn't it? Look at this big move here. This low to this high. That's a significant price move. Why didn't it hit that level and go up if it's all about support and resistance? Because the narrative is it needs to rebalance down here. There's a larger pool of liquidity over here, even though we have these relative equal lows here. Yes, there are traders on YouTube that have looked at my things and think, okay, this is where it's going to go. And they had no idea that it was going to come down to here or even come down to the order block. They don't know. They do not know. And this is the reason why I said this morning, this afternoon rather, on Twitter, to someone that was inspired by one of my tweets saying, I'm going to teach because I saw this. And I don't want any of you, number one, teaching my content. Second of all, I've already determined how far I'm going to go with what I'm going to teach because there's too many people playing Robin Hood with it. So it's unfortunate, but there's a whole lot of things I'm never going to teach you now. I'm never going to do it. Now, some of you might throw your hands up in the air. Oh, this is ridiculous. Look, if I stopped right now, you're way, way, way beyond anybody else's ability to teach you in terms of clarity, visibility, and real interbank delivery. No one else touches this level. No one. So don't send me emails complaining. Don't cry to me on Twitter about, oh, you promised this, you promised that. I promised and delivered already. I've already delivered way beyond what you would ever learn from anyone on this planet, because you're never going to learn this from anyone else. So don't cry to me. Don't complain to me. I'm just telling you, I know where I'm going to go, and I'm stopping. I'm not going to go beyond that publicly. My children will learn it. If they want to do it later in life and start teaching it after I'm gone, that's their decision. But they're the only people I'm going to teach everything to. Okay, there's a lot of lessons still I have in store for the mentorship. There's a lot of lessons for the algorithm side of it. But some of these things are just never going to meet public. It's never going to happen. Okay, it's never going to happen. So, you guys that are over there, okay, sharing and trying to reword everything I'm doing, you have yourself to thank for all that, because I know this stuff. I know it like the back of my hand. I can do it and I can teach it. And I don't need to do this mentorship. I don't need to teach anybody anything. I love doing it. But I've warned so many times not to take my content and teach it. There's a company called iMarkets Live, or IML, and there's several people that got their hands on bootlegged copies of Saeed's videos while he was in the mentorship, before I threw him out for sharing. And they have been making their rounds on the internet. Okay, and we have done so much more teaching beyond just those little 12-month concepts and lessons. They're foundational, but they're taking those lessons and they're teaching it through IML, and I'm actively building a lawsuit against them and every member. I have 4 of them that actually signed up to the mentorship, and I removed immediately as soon as I found them. And I have their personal information. I'm going to subpoena the iMarkets Live company, and I'm going to make a public statement about that soon on YouTube, because they're frauds. They're absolute frauds. And the guy that runs the show, he's a scammer too. He claims he's a profitable trader. He's a superstar trader, and he looks like a watered down Anton Creel. So he's a greasy old New Yorker from Brooklyn that just literally rips off everyone, and he screwed up by touching mine. So that's all the inspiration that led me to discern where I'm going to go with the level of teaching. The price action models and the trading plans, when we get to that and the completion of that, all of the live market commentary, like what's going to happen next, that stops, and we're going to all go back to hindsight. And some of you are going to be upset about that, and I'm okay with that, because you're still going to be learning. But what I'm actually seeing here is a great deal of people going on, and some of them are in my 2016 charter group. They have YouTube channels, and they're taking what I'm telling in this audience, they're taking that and they're basically parroting what I said without teaching. They're saying it's going to do this, it's going to do that. And what do you think is going to happen? Everyone that's watching them, they think, well, naturally, this guy's smart. Look, he's figured it out. He knows what's happening. When you're really not doing that analysis yourself, you're just basically parroting what I'm saying. So I'll be real honest with you. I'm pissed off. I'm pissed because some of you just don't understand. I'm not here with a pen in my hand saying, feed me and my family. I don't need that. I don't need any of you in this mentorship. I don't need you to send me any more money. I don't need you to do anything for me. Okay? I'm doing this because you paid me. I'm doing this because I love it. But I'm losing the passion to do this because there's too many greaseballs in here that are abusing it. And they've created alternative personalities online to hide what they're doing. They're renaming what I've taught, and you cannot find any of it prior to 2016. Like all of a sudden, people are now start talking about fair value gaps. They're all talking about, they're teaching breakers and they don't even have the breaker in the right spot. They're talking about a specific candle being an order block, and it's not an order block. Okay, the level of irresponsibility has gone through the roof. And I know I'm in the middle of a discussion about Eurodollar, but I have to get this off my chest because I'm totally disgusted by some of the people that are in this group, and you know exactly who you are. And while I have not moved on you yet, I will. And just know that whatever you've imagined by joining here, because I'm sure some of the group that this came in the latter portions of 2019, they're trying to run their little Instagram service, okay? And I'm 98% accurate. So the things I talk about, they happen. And I'm marketable in such a way that I'm not looking at other people's stuff. I'm not putting harmonic patterns on my chart. I'm not drawing trend lines. I'm not doing supply and demand zones. I'm telling specific price levels each week, and they hit. I'm one side of the market, not two sides, not plan A, plan B, and then talk about, see how well it worked out here. Okay? Everybody knows that about me, and they're joining. The lazy are joining because they're taking what I'm saying, and that's why the ones that are sending me emails saying, hey, can you not do these videos for so long? Because they don't want to have to go through an hour-long video to pull out what is my opinion about the marketplace so they can go on their Instagram and put a chart up and look like a brainiac. Okay? I'm not stupid, folks. Okay, I knew this was going to happen, but it's gotten to a point where it's rampant now. All of a sudden, everybody knows institutional order flow and IPTA. These are my creations. These are my concepts, mine. Okay, when people came to me in the past to train under me, they had no idea what this stuff was, and they were coming from the industry. So if this is what everybody knew all along, like guys on YouTube that will comment So, oh yeah, we've been doing this stuff for 50 years when I was a pit manager in the Chicago Board Trade. No, you were not. Okay, you were not. Okay, you were not doing it. Okay, because those types of people came under my tutelage in the 90s. Okay, so I don't want to hear the crap. I know where I am. I know where I came from. And I know these 20-year-old kids, these know-nothings that are out there just completely taking advantage of people. Number one, they can't trade. They don't know what the market's going to do next. They don't know what side of the market to work on. They don't know how to find an entry. They can only talk about what's happened in the past. And they basically have Saeed syndrome. So I don't care if I come off as arrogant. I don't care if you don't like me as a person. But this is my intellectual content. These are my things. This is my property. And you are just guests in my house here. That's all you are. You're guests here. You're in here learning something that this is never yours. You're able to use the information, yes, but you are never ownership of it. You have never, ever, ever been promised ownership. You don't have the rights to teach it. You don't have the rights to share it. You don't have the rights to rename it. Okay, none of that stuff's been a privilege been granted to any of you, and it would never be. So my vision for this mentorship was something completely different to what I've basically reduced it to. You know, there's a lot of lessons that we still have to complete that rounds out what has been provided so far. But I absolutely have a definitive line where I am not going to cross that I didn't have initially. And some of you that have recently started, you're probably feeling, well, you know, I don't know if I'm going to stay with this mentorship. If that's how you feel, quit. I don't care. Because I'm not going to twist anyone's arm to stay here. The folks that have been here for a long time, they know the value that's here. And again, they will tell you if I stopped right now, it's still light years beyond anything else you're going to learn. Because I tell you how to find the market direction. I tell you how to find the setups. I tell you how to do it every single trading day. There's an opportunity there if you look at enough pairs. I don't want you to feel that you do that as a daily habit. But I do believe that there's just too much abuse. And at some point, you know, someone has to say, okay, enough is enough. And I've gotten to that point now. So will it deter your ability to find success in this? Absolutely not. Because even if a member just joins for 1 month here, studies what I taught in month 1, and never, ever, ever learns anything beyond month 1 content, and just follows the process that I go through with you in the weekly commentaries, you will have a model that will be a lifelong ATM machine. But some of you want to go beyond that, and I understand that. And there's lessons that go into deeper understanding and deeper concepts that bring a whole lot of clarity together that would simply not be available to one if they didn't absorb all of it. So I wanted to be very candid with you all this week because, like I said, I get people all around the world. They join other people's services and such, you know, and the new thing is, because they have had their hands on copies of just the lessons, okay? And the lessons are, again, they're just foundational. They're pieces of a puzzle. And it's just like when I, brought out the order block. You know, all of a sudden, everybody thought an up-close candle was a bearish order block. And they're losing their money. And they're saying, oh, it's fake. It's this, it's that. They don't know what they're doing. Do you give a loaded gun to an adolescent child and expect them to be able to hold that and not hurt themselves? Nobody in their right mind would have that expectation that they could handle a firearm like that. So when I give portions or parts of a lesson, a context, okay, it's not something that, you go to month 5 and say, okay, I'm learning month 5 content. It's a lot of stuff. It's a lot of stuff. You got seasonal tendencies there. You got IPTA data ranges. You have all kinds of things. And by themselves, if you're weak-minded and you're in here just trying to cherry pick what you think you want to use, of course, a lot of people quit at month 5 because they thought, oh, it's mumbo jumbo. Oh, it's filler. It's a whole lot of crap ICT puts around all this stuff. No, these people are an idiot. They're stupid. They're absolutely stupid because month number 5 is a major block of information that I have to go back into with the trading plans and the price action models. If you don't have month 5 under your belt, the plans, the trading plans and the price action models when you're in charter absolutely are useless to you. They'll be just like more moving parts, but you won't be able to bring it together. The IPTA data ranges have a specific role. They tell you how far to look back and how far to look forward when the setup comes to fruition and when it forms, and what's the framework, how many days back, and then how many days back if there's a structure in play. If it goes beyond the maximum IPTA data range, what do? There's a procedure. But these people that come in here and they get a hair up their ass, basically, okay, and think, hey, this is all filler. It's all fluff. There's nothing in this mentorship that's filler. There's nothing fluff except for my rants. Okay, but they're necessary because I'm communicating to you, number one, how I feel about what's been going on. 2, reminding you that this can stop at any time. I'm not obligated to do this the rest of my life. Okay, I'm not obligated to teach you everything that I know. I do have a lot of lessons that I need to do to round out what I have. But the lessons that I had every intentions of teaching, I'm never going to do those. I'm never going to do it. Because as soon as I post it, it gets downloaded and someone's actively putting it into a chat room, or they're actively taking it and creating PDF slides off of the video, and then they're adding their crap notes on top of it and completely adulterating the content and context of what the lesson is. And they are pretending to know something. They have no idea, absolutely zero idea about what they're talking about or how to use it to make money. They cannot use it to, look, here's the thing. I have 0 students that are hitting my level of accuracy. Okay. I get questioned all the time. I get ridiculed on Twitter. You are here. You hear me telling you right now. I do not have any students. They're nowhere near the level of proficiency I have. Now, I'm talking about people that have been with me before mentorship started in 2016, in August of 2016. That's when it started doing it. There's no member under my tutelage, not one, okay, that has the level of proficiency that I have. So they don't have it. No one's there. If they did, I would be pushing them out to talk with me in front of you in the mentorship. None of them have it. There's people outside the mentorship that got their hands on just some of the lessons, and they think that they're going to run a professional price action course now. Okay, and they're out there saying the ICT doesn't teach this, and the first thing they start talking about is order blocks and breakers. Come on. Come on. There's a guy down under, okay, he says he's figured it all out without me. Come on. You're looking at parts of my lessons, okay, and all you're trying to do is create an image. You're trying to create an image off my back, and that pisses me off. Because none of you are going to find someone out there that has figured this out. No one's figured this out. It was gifted to me. Okay? I worked very, very hard doing the wrong things, and I had my eyes opened. You would have never figured this out. No one would have. Otherwise, it would have been done before me. But the things that I'm seeing and what they're doing with it, Lamborghinis rented and putting themselves around cars they don't own, going in homes that are for sale but they don't live in, okay, walking around in clothes that they're going to hide the price tags on because they haven't taken them off yet because they can return it and get their money back. This is what is happening with my content. These people are out there doing that kind of stuff, and they don't know how to trade. Even with this content, they're only talking about things in hindsight. So I just want to remind folks, okay, there is a limit to me doing what I'm doing right here. These weekend and midweek reviews where I'm giving you my opinion about what's going to happen. 2020 is it. That part of the mentorship is going away because there's too many people in here that just joined just so they can do what I'm saying and basically just parrot everything I say, or reword it in such a way where it sounds like it's theirs. And I told everyone when I first started this mentorship, I'm not your sugar daddy. I'm not going to give you things to go out there and peddle and make money, make yourself rich, and not actually trade. And that's not what I'm doing. Okay, it's been done by other people. And there's a lot of people out there that's made lots of money off of me. Okay, taking my stuff and selling it. They don't know how to trade. They don't know how to answer anybody that works under them as a student. Okay, and it's unfortunate. It's absolutely unfortunate because there's people out there that are getting rooked and victimized by these people, and it's a lot of folks outside the United States that are doing it. And I don't want to point my finger and say it's just these individuals from this particular country, but I already know where majority of it is. It's South Africa. So I understand the economic front down there is terrible, and you're probably desperate to do anything, and you'd probably cut my throat, to save your own ass there. I get it. But from where I'm standing, you're never, ever, ever going to have my best. And you think this is amazing. There's nothing like, you can't even imagine. You can't even imagine where I am. When I talk about things and you watch me do videos where I recorded myself doing it live and ran those accounts up, there was no MT4 rented server to do that. Everything that you see me doing in these commentaries, it's the same thing I'm doing in that 1 minute chart. Everything, I'm predetermined where I think price is going to go based on my understanding about the algorithm. Now, if I don't know what I'm talking about, these things that I talk about with you on Wednesday and on weekends wouldn't unfold like they do. And I know how to do it on a 1 minute chart. I know when these markets are going to turn by the calendar day and the calendar hour and the calendar minute. I know all of that. I'm never teaching that. I'm never going to teach that. I will never divulge that now. Now, was it a pipe dream of my own to even think that I could get to this far without someone ripping me off and doing what they're doing? No, I was aware of that. But seeing the level of it right now, and they're just giving out pieces, just pieces. I'm approaching 1,000 videos soon in this mentorship, 1,000. And these people that get out there and they watch a couple of things with PDF files and a couple of videos, and they think, I got your whole mentorship. No, you don't. No, you don't. No, you do not. You don't have any idea what you're talking about. Now, they can say those things and then turn around and say, here, I got videos for $10. If nothing's for free. Unbelievable. Like, I'm watching this. I see it. And 90% of it is the same person that's been banned for years now. It's their copies. So what was meant to derail me and hurt, my teaching and hurt my image didn't do any of that. It's changed my approach to being a mentor. I'm gearing back the level of things I'm willing to teach, but it doesn't diminish the effectiveness of what it's already been taught and where I'm going to lead everybody to. So your question is going to be this, and I'm going to head off any attempts for you to send me an email. Well, if you're not going to be talking about with the mentorship weekly reviews and midweek reviews about what the market's going to do, what will it look like? That's what I'm still trying to settle in on. Like, what do I want to do with it and what approach I'll go with it. I'm quite certain that majority of it's going to be a price action model that I'll have to create in addition to the 12 that I already got. And then we'll just use that as a study. And it'll probably be something along the lines of a 30 pip per week model, where I basically say, hey, look, this is what we're looking for. And we'll just follow along in that thought process, not cable and euro and dollar and anything else that comes to mind. It's going to be something that just gives you a bread and butter approach to finding weekly setups that aren't a lot. No one's going to go on Instagram and say, join my service, it's 30 pips a week. It's just, no one's joining for that. They want the 200 pips, the 500 pips. They want that. They want to chase the Lamborghini guys. And I can make more money than any of those guys added up together. Find 10 of them, with 30 pips a week, I can blow them out of the water and collectively. So just know that I'm not reducing the value of the mentorship, and none of these things are promised in perpetuity. Okay. Where I'm going with this is to help develop you as an independent thinker. And if I continuously forever just tell you what I believe is going to happen, again, it develops a sense of codependency on me, and that's not what I want. I want a legion of you that can do this on your own. And the only thing that's keeping that from happening is your willingness to step out there and just do it without me holding your hand. You all did it. When you were a child, you held your mother and father's hands and you just walked. And then eventually the parent says, okay, it's time for you to start doing this on your own. And we're getting to that level. Now, some of you, again, and maybe you're listening to this video now because in a couple of days, a new bunch of people are going to be joining and they're going to hear this video and they're going to be like, what? Oh man, this is the worst news in the world. It's the best news. Okay. It's the best news because you still have this calendar year from me as a mentor talking about what I think is going to happen. So everyone out there that are in the mentorship here, you better get your motors really running if you're trying to rip me off. Okay. Really start to really get your audience members paying attention this year. Okay. Because after this year, no more free rides. I'm not going to talk about what the market's going to do going forward. We're only going to talk about what's already happened. And at that point, we all honestly can look at this and say, I've earned the right to be able to talk about hindsight. I know what I'm doing. I know what's going to happen before it happens 98% of the time. It's not perfect. I've never claimed to be perfect, but I'm not going to be abused. Okay. These are gifts that I'm giving you. You may have paid for them, and it may be a sacrifice in your eyes, which you paid to get here and have this content. 5 years from now, you're not going to look at it like that. You're going to remember what it was like to get through it, but you're going to be like, this is way, way, way too cheap. Way too cheap. Because I'm giving you and your family a legacy that no one else would have given. And you wouldn't have found it in a college. You wouldn't have got it in some executive cushy job because you have to be subservient to that. Here, you don't have to be subservient to anything. You carve out your own direction, your own niche. Everything in your life is now limitless. As long as you have breath and ability to think rationally and resources available to you, there's no amount of success that's too much now. Everything's attainable. You just need time to get there. But the hand holding and the here's what's going to happen next stuff, folks, if you joined and you think that's going to go forever, no, it's not. You're going to learn, but I'm not going to be laying candy in your hand after 2020, because 2021 mentorship takes a different direction. And the folks that are running services that are just parroting what I'm saying, be mindful, because I'm going to be putting things in your hands this year that ain't jade. And the people that have studied will know when it is and when it isn't. And if you're in here just taking my stuff and you're giving it to services to collect subscription money, you're not going to have 98%. I'm just telling you that right now. Read between the lines. All right, so anyway, back to euro dollar. We came down regressively, ran into the buy side imbalance, sell side inefficiency, ran the sell side liquidity out here, two bullish order block, beautiful run to that, went beyond Abyssy a little bit, that's fine. Direction was right, where we were reaching for was correct, and now where do we go? We can come back up into this area of liquidity where old institutional order flow was. We had sell side liquidity there, and now we have a fair value gap. So price can come back up into that, not because it needs to come back up to this old low, because that's support and resistance theory. It could come back up in here, rebalance, and hit the bearish order block. That's the context. That's the reason why this level, if it is traded back to it all, because it doesn't have to do that, but if it does and it bounces up into this area, 110.65, 110.70-ish in that area, that could be a catalyst for the next leg lower to run the sell side liquidity out here. And the anchor is, again, the magnet. This is the draw on liquidity. It does not mean at this moment that price is going to go straight down to that level. That's not what I'm saying, but I'm saying from a directional bias on the daily chart, that's where price is most likely to be drawn to. Now, if we go a little bit lower, or if we start to rally up in here, the effects of this draw may diminish. but for now, that's where I'm thinking price is going to go. So we need to keep our focus on any kind of premium array to frame a new leg lower. Moving into the hourly chart, the fair value gap that I outlined on Wednesday, saying that that's where we're probably going to see it run up into. It was exactly as I outlined, beautifully done. And again, the eyeball is just to remind me that this is your SMT divergence. We'll talk about that again in a few moments when I get through the commentary for Euro and cable. Cable doesn't have a whole lot to talk about, so it won't be much longer before I get to that portion. Sell side liquidity has ran out on multiple times here, okay, and then came back up into the bottom of that old daily fair value gap on the daily chart, and then consequent encroachment, and then sells off. Fair value gap in here, rebalances on Friday, and then distribution again, rolling into the buy side imbalance, sell side inefficiency, fair value gap on the daily chart that we've been looking for months. And now into the 15-minute time frame. Here's that 60-minute fair value gap that I outlined on Wednesday. The price would reach up into that. It did that. I did a recording also showing you at the very moment the price ran up in there on the ECB 7:45 a.m. and 8:30 a.m. Announcements for Eurodollar in the New York session. We went right back up into that daily old fair value gap, consequent encroachment. Beautiful. SMT diverges on top of it. Optimal trade entry. Slams it down into the daily buy side imbalance, sell side inefficiency. Beautiful little bounce in here, comes back up, rebalances here, relative equal highs, and then pops up in London on Friday. Look at your SMT divergence in here. You'll see another USDX SMT bearish divergence where the dollar index did not make a lower low, where the euro did a higher high. Finally, moving into cable. All right, so we have the buy side liquidity pool here, sell side liquidity pool here. Untapped fair value gap, we've been extending that out in time. Bearish order block here, I just added that. I had no real convictions about British pound. I'm not going to make any bones about it. Just go back and listen to the last two videos. Really uncertain about what it was going to do, and I'm glad I stayed out. Hourly chart, you can see we had buy side liquidity here, ran up on Friday, took that out. Imbalance here, buy side imbalance, sell side inefficiency in the form of BISI, fair value gap. Rebalance that back down to the top of the fair value gap that's defined on the daily chart. Right now, I believe the next draw is here. We have a buy side imbalance, sell side inefficiency, and it's also towards the end or low end of that fair value gap. So while it's framed on this specific candle here, it could come down into this level here and then attack the sell side liquidity resting below here. Larger pool liquidity and draw would be on these relative equal lows here. So near term, we're looking for this, and then this here. This could be the catalyst on its rate announcement, as I mentioned on the economic calendar. Moving on into the 15-minute time frame in here, the breaker, we traded up into it here, and I don't believe it needs to come back up any higher. So while we do have a small little fair value gap there, if we get any rally, I'd like to see it be kept at bay here. I don't want to see it come all the way up into here. There's no necessity for that. I don't like this here to be rebalanced. It's not necessary. So it runs it back up in the air. I lose all interest. It would need to sell off, create an imbalance in the form of a SIBI, sell side imbalance, buy side inefficiency, and then fill that, and then another short would form. That again, that's if it fills this in. I don't want it to go up there as it is right now. And again, the buy side imbalance is here. Lots of liquidity resting below here and a smaller level in here. So if we get some kind of wild price action and further upside for the dollar index, that would really spool price lower on the British pound, reaching for the levels that I indicated on the hourly chart. All right, so let's go over to TradingView live, and that way I'll kind of like give you a lesson on intra-week order flow, and I'll also show you how to put that SMT overlay on. All right, so we're looking at TradingView. This is a live. You can see it's basically 3:40 p.m. Saturday, January 25th, 2020. Now I'm going to say some things in this video, obviously, that's going to, if you were just now watching it for the first time and you don't have the benefit of being with us every step of the way, you know, that led to where we're at right now, it's going to seem like a whole lot of rear view mirror discussion. And I want you to completely come to grips and come to terms with that, because eventually we're going to be moving into that, because there's going to be a whole lot of things that I need to teach that will be done from a hindsight level. You're going to be getting a lot of homework assignments in 2020 that will also require hindsight review, because that's how I learned this. Okay, no one sat down with me and said, Michael, look at this, and then look at this, and look at this. It didn't happen like that. Okay, I had to go through the price charts and see certain things that repeated over and over again, with specific understanding of as to why I should even be expecting it to form. Again, that's the algorithmic points that you have to learn, why certain things are expected, and if they occur, you do this. If they don't occur, you don't do this. It's a if, then, or process. And there's a lot of scenarios that would be available to someone that is going to operate outside of a specific framework. If you listen to my commentaries, okay, and you start looking at how price is offered in terms of what may be likely in terms of the direction, that's our bias, okay, and that's why I teach from a week end before the week starts. So I co-sign with my opinions before the market even starts opening and trading. And then midweek, where we have typically the Monday, Tuesday, Wednesday effect in play already, that's why I do the Wednesday midweek review. I can go back and draw your attention to what has been framed from what was said the weekend before and what we have now presently in price. When I give you those little cookies about where I think price is going to go, it's your job to go into the charts and study what forms between when I made the video talking about where it should go to, and then while price is moving towards that level. The note-taking is a factor that is required on your part. Now, I put lipstick on the chart, but there's a whole lot of other things on the charts that you should have, not just what I have. And it's something that you're going to have to accept as the work part of this. And again, as I mentioned before, the lazy don't survive here. And I understand people don't get what they were hoping to get when they first come in here, because they want to be spoon-fed, buy here, sell here, put your stop here, and take profits there. I go beyond all that, and I tell you why the market should do what it's doing. That way you understand the characteristics around what it is that makes me believe the market's going to perform as it does. Now, again, it's not 100%, but it's really, really high. So when I give you a directional bias, okay, and I've made things very easy now by having that little magnet icon, so there's no ambiguity now, okay? I had people in the past in 2019 say, well, you said this and you said that, and even though I was very clear in my discussion saying this is what would negate the idea, and if it does that, this is what it would do. That's not plan B. I'm not subscribing to that. I say, but this is what I believe is going to happen, and then this. Okay. Now, again, it's not 100%. It didn't unfold 100% of the time, but 98%. Go back and listen to everything I ever said. Do the math on it and how they come to fruition. It's 98%. That's how I got the number. I got questioned one time. How'd you get that number? It's math. Do it. It's there. So if we look at the midweek and the week ending reviews, and I'm drawing your attention to specific levels, okay, how can you operate in an intra-week order flow to find setups or practice them or study them in hindsight? Because you're going to be doing a whole lot of that, probably more than you will be watching it live. A lot of you have businesses, a lot of you have jobs or whatever, and you can't actively sit in front of the charts, and I get that. But what we want to do is give a context to how intra-week order flow is derived and what it means to work within it. Now, I'm going to flesh this chart out a little bit as we go, because it needs to be done. Otherwise, the lesson won't be as impactful. So there's an equal highs here, and I mentioned this before. Go back and watch the recordings. We ran through it, multiple failures. broke down. Okay, so at this moment right here, this was a shift in market structure. On which time frame? The daily. Okay, so the daily chart now has a change in its underlying bias. It does not mean from this candle here, every single candle is a down candle. Okay, this is one of the things that when traders come to me, they think that, okay, there's a market structure break, so every day is a down day. Every day is a sell between 2 o'clock and 4 o'clock in the morning. No, there has to be a measure of context added to it. And we understand that the market has to trade to a premium if we're going to sell short. So at this moment, when price went below this low here, is this market in a premium or is it in a discount? It's in a discount because we have a high here and the low is here. So, and we broke the market structure at this swing low on this particular candle. We need the market to trade back into a premium. When does it do that? Well, if you look at this high to this low, and I'm only using the fib to illustrate the 50% level. It's not that there's any specific magic to the fib or dependency on the fib. It just means that this is the easiest way to graphically depict equilibrium. Okay, so here's 50%. So when price came up to here, did it go to a premium? No. How about here? Yes. Here? Yes. So at or above, at this price point here, we can be now a seller. But just simply because it trades at the 50 level doesn't mean anything. There has to be a PD array that we align it with. And it just so happens that there's the bearish order block right here, last up close candle right before this move here. So we can be a seller inside this candle's range. Okay, and I'm going to change that to red or deep red, and then I'll take the fib off because it's accomplished its role. So right here we can be a seller. So I'm going to put a little box on that, on these two candles here at that level, knowing that when we drop down to lower time frame hourly, this is the framework and what we traded on. Okay, so I mentioned at the time of that particular candle and this candle here, it could spike up to 1180, but then we were looking for this move anyway. So I gave you a measure of how far it could reach up, but the context was still we're looking for it to go lower. Dropping into an hourly chart. Okay, here is the price structure on those two highs that reached into a premium. At equilibrium and above is a premium when we're bearish. So when we have that, what we're doing now is we're looking for old highs. Okay, you should be writing this stuff down now. The context is the market's bearish. Real quick, let's go back to the daily. I'm going to remind you of why. We were looking for the market to reach down and rebalance here. Okay, we were looking for the market to reach into this BISI, buy side unbalance, sell side inefficiency on the daily right here. So we were looking for a sell that could have formed at 1180, but it's not required to be at 1180. The market hits a premium array and then sells off after the market structure is broken. This is our draw on liquidity. So here's our target. So I'll change this to green. So that way we know. That's the finish line. Okay. Now the framework is we're looking for a sell anywhere in here to a draw on target down to here. So here's the point of origin and the terminus is down here. So in between these two price points, okay, in between these two price points, we're going to shade in another box. Now in my mind, this is what's going on. All of this, okay, is your range, your projected unrealized dealing range. This is where we're going to see it trade. I don't know how many candles it's going to take to get down there, but I know that it's going to go to this level to rebalance because all the structure is changed went to a premium, lots of sell side liquidity, and we also had a lot of retail ideas and sentiments. It was through the roof bullish on Eurodollar and bearish dollar. And all the champions and gurus got it wrong. So going into the hourly chart, let's do it right the first time, Michael. The hourly chart. So inside this shaded area, okay, we're working with intra-week order flow. So anytime you see an imbalance where it's just one single candle that trades within a specific range of price and doesn't have any overlap with the candle before it or after it, like it does here, that's a fair value gap there. We have a fair value gap here. And we have one in here. And where else do we have one? We have one right here. And well, you know about that one. That's when I called live before it happened, rather. And now, institutional order flow intra-week. When we trade the fair value gaps, your setups will form by retracing back to premium arrays in one of two manners. It'll trade to running buy side liquidity, or it will run to a rebalance. And we'll go one more over here simply because it's necessary. And then finally the last one here I mentioned in our commentary. All right, so looking at the market rebalancing, that's all we're looking at here. We're not looking at runs on buy side liquidity here. We're just simply looking at points of rebalance. We don't get a rebalance to this fair value gap here, so that never traded to. Totally different opportunity exists there. We have a fair value gap here. The market trades back up to it here. On what day? Tuesday. It creates what? The high of the week. Go back and watch last week's commentary, the weekend before, and you'll see that that's where I outlined it on the charts that were posted to the forum. Okay, so you'll see that that level was called, the setup for that, creating a high of the week, and then the secondary sell-off was here ahead of it during the Wednesday review, and then where we're at now. Point of rebalancing here, we have a swing high, swing low, market comes back up into here. What day is this form? And we're talking a little bit about algorithmic theory here. Monday. So Monday, is that a day that is high probability trading? No. Why? Because it can create this scenario here, consolidation, and it expands above the consolidation on Monday. On Tuesday, that creates the high of the week when it's bearish. Remember, inside this shaded box, intra-week order flow is bearish. So where do setups form? Time and price. The price points I've already outlined here for rebalance. Now, when we get to this point here, this is both rebalance and it's also internal range liquidity that runs buy side liquidity. And I'll explain that in a minute. So this fair value gap, while it exists, it is not one that we could sell short and have a lot of confidence in because it's Monday. Monday's trading. Also, we've already ran out previous lows. See that? So here, this fair value gap is not high probability because number one, it's Monday. Two, because I already know there's somebody in here saying, oh, I always trade on Monday. Michael's always talking about how he doesn't trade on Mondays. It's a low probability. I've made so much money on Mondays. You made money because things weren't like this. Okay. The old lows, we have already offset the sell side liquidity here with this run here. So running back up to here is not high probability because it hasn't moved back to a premium. It has to get to a premium. What's the premium? Well, look at the range we're in. We have a swing high here to the swing low that forms on Monday. Here's 50. Is that fair value gap at the premium? No, it's not even at equilibrium. But this one is. And we're inside of this fair value gap. So this one now is nice. On what day of the week? Tuesday. Oh, wow. So now we have a couple factors here. bearish institutional order flow expected from the daily, intra-week order flow that's framed inside this box here, okay? This is the target. Now, this could have sold off all in one day and went right down to the target, or it could have did it on Thursday and went right down to it instead of consolidating. There's things that I'll teach you that leads to those understandings of when it will do those things, but right now you need to learn where do the setups form and the bias. So the bias is when I give you the context on the daily chart, you work on that side of the market only. You don't go in there trying to find SMT divergence and try to go long and tweet things to me saying, look, I bought this, ICT, I did this. Guys, I'm not high-fiving that. You're going against the outlined order flow that I've been teaching. So this run here on Tuesday, that's high of the week conditions, which is what I gave you on the charts that were posted before it happened. The market runs down. We go deeper from this low and this low here, and we have a small fair value gap in here. Same scenario as we have here. Just it needs to go to a premium, more of a premium. Why? Because now we've gone through this low, 1, 2, and then over here. So now we've worked several levels of sell side liquidity, and it's dug into it deeper and deeper and deeper. It needs to move to a premium, a more pronounced premium. And we also have what on the economic calendar front? The ECB announcement was due on Thursday at New York. So do you want to trade ahead of that and not allow it to have protraction on the upside greater than this? Because this is by itself is 50, yes. That's a sell, that's a sell if we didn't have the economic calendar. Oh, so now there's algorithmic principles mean much more to you now because we're looking at time and price, and we are now filtering in the aspect of manipulation. This is the manipulation part. Okay, so when markets go into protraction based on the economic news that's provided by way of the Forex Factory calendar that I share every weekend edition, the market moves to this protraction into the fair value gap. Then this is another sell, which is exactly what, again, I told you in the review on Wednesday. We would see this scenario here. It's a little higher than I would like to see it trade to, but it's still good because it would get too close to this Tuesday high, meaning that if I was wrong, the scenario would have been this. It spikes through Tuesday's high, makes the high on Thursday, but still goes down. That's where I would have been wrong, but still right. And I know it sounds like an oxymoron, and it kind of is, but the context is we were aiming for this down here. So Thursday, when we get the ECB announcement, we run back to imbalance, hits it, and boom. Now let's look at Friday. Same thing here. Fair value gap, runs to it here, last bit of the fair value gap, and then sells off and really fills in the imbalance. It's done on Friday. It's completely fulfilled its role. If we now look at the context of running out buy-side liquidity, you're going to be looking at equal highs or old short-term highs. And when the market does that and trades into a kill zone, you have a setup. Relative equal highs. There. And then obviously here. So you have a sell here. Buying, the buy stops are being rated. So you sell to the buy stops. Buy stops above here. You sell to the buy stops. Relative equal highs. You sell to the buy stops. Relative equal high. Well, imbalance, and then it's an old high too. Buy side liquidity runs above it, and then sell to the buy stops down. So with my concepts, you're doing one of two things. You're pairing your order with buy side to sell short, or you're pairing your order with sell side to go long, or you're looking for IPTA to go back to a point of rebalance and following the footprints of smart money. Now, you are kind of forecasting what they're going to do, and that's the highest order of price action delivery, knowing when it's going to rebalance and then turn. Running the stops is a little bit easier. That's why some folks kind of like to use that setup and couple it with optimal trade entry. Then by blending that with this framework, you're comfortable working with an intra-week order flow. So there's basically, that's mentorship in a nutshell in terms of the two stages of entry. You're either using internal range liquidity or external range liquidity, and you're entering and exiting on one of the two. And if that went over your head, trust me, it's explained in the content. All right, so now if we want to look at, let's get everything off the chart. And if you want to add a SMT divergence, you click on compare. And since I have Eurodollar on, you type in DXY for the dollar and make sure it's on all, because otherwise it wouldn't show up. And you click on the CFD TVC, and then it'll overlay it right here. And you can see the divergence right away. You don't even have to do anything to draw your attention to it. You should already see it. Higher lows when it should have made a lower low when the Eurodollar made higher high. So this point here, okay, which is this low, this point here, which is this low, this is not lower. It's in the line form, it's very clear that it didn't go lower. If you look at the dollar index, okay, and clear everything off, lower, and then we add Eurodollar, Forex, and the Forex.com data feed. Okay, again here with the line chart on the Eurodollar, it's very clear that you don't get the higher high in euro when you get the lower low on this swing. So SMT is inside of this, from this low to this low on the dollar versus the hourly highs on Eurodollar. This low should have went lower than this low, like it did the higher high on Eurodollar. It didn't. But right in here, you can see the divergence. If you missed that one still, this low is breached by this one, but we don't see that here on the Eurodollar. It fails. So basically all this is showing you is accumulation of dollar and distribution of Eurodollar. Strip all that away. How do you know when SMT is going to work, Michael? How can you trust it? I got that email again. I get this so many times. Look at me, I'm putting SMT in there. Okay, and click on that, get it off. So in here, we've already outlined the fair value gap. I gave you that before it happened in the Wednesday review. Okay, so here's a Wednesday. I did the review, and then the market went right up to where I said it was going to go, and then sold off and went to where I said it was going to go. The SMT divergence is a qualifier and a confirmation tool. It is not a trade selection tool. Too many people outside of our mentorship, and some of you that are in here, are leaning on SMT to provide you the setup. All it does is gives you a visual representation of the level of buying and selling because of the correlation that breaks at that moment. All of this run up here is all stop running. It's running these equal highs. You knew about this run on Wednesday in the review based on this here, but now we have it in hindsight. We can see that it was performing an SMT divergence between the dollar index and the Eurodollar here. So it's not that we were going in looking for SMT. We were looking for price to trade to here. If SMT forms, it further significantly increases the likelihood of that trade being correct. That's all the SMT does. It is a smart money technique or smart money tool, not setup. The SMT is not a setup. It is a filter that helps frame a measure of likelihood. Okay, so can a trade be viable without SMT? Yes, but you're going to find that the better trades have the SMT in it, and it has a premium array, and it has time of day, day of week, trading inside of intra-week order flow. Intra-week order flow is basically what we're looking for from an hourly chart up to a 4-hour chart. So between 4-hour and 1-hour chart, you're looking at intra-week order flow with that. Now, obviously, inside of the smaller swings in here, you have a 5-minute or a 15-minute time frame that you could work within too. But I just want to give you the context relative to what we're seeing here on the hourly chart. So hopefully you found this insightful. Until I talk to you next time, wish you good luck and good trading.